Good afternoon, everyone, and welcome to the Native Learning Center's Cathedra Online. Today's presentation is called Understanding Your Financial Statement. Our presenter today is Ms. Christine Dennis, CPA of Rieger Carr in Monroe. Before we get started, I just have a few housekeeping slides. We encourage interacting during today's presentation. At the very top of your screen, you'll see a little man with his hand raised. If Christine asks you a question, she may ask you to agree or disagree. Feel free to use those tools at the top. And I want to highlight the step away option. You may be at work and need to check an email or take a phone call. Feel free to do so. Just click step away rather than closing your room out. This can ensure that you'll be able to return to the presentation with much more ease. I also want to explain the chat box there. To your right, you'll see there's a chat box. And that's where you can ask Christine any questions you'd like as it relates to the presentation, and she'll try to get to your answers as soon as possible. At this time, I'd like to bring on Ms. Christine Dennis.
Good afternoon, everyone. I'm going to talk about the fun process of accounting today, so I hope you're ready for a whole lot of excitement. We're basically going to try and cover just an overview of accounting and your financial statements and what they actually mean. Because we only have 2 hours and it's a lot of information, it is going to just skim the surface. If you have more specific questions, feel free to email me. Maria will put my contact information up at the end of the day. Okay, so let's get started. The official definition of accounting is that it is the process of recording financial data for all receipts, expenditures, assets, liabilities, net position, and includes the analysis and measurement of financial information. Okay? The information is reported to external and internal decision makers, as in management, business committee, housing commission, and HUD. Now, the simple definition of accounting is what do you have? What do you owe? Where did it come from? How did you spend it? And what's left? Any questions yet? And I'm going to encourage you as we go through to just, if you do have a question, feel free to just start typing down there and we'll pause and make sure you get your questions answered. Okay. I'm going to kind of just talk about some of the basic terms here. Assets, something that the entity has acquired or purchased, and it has some kind of monetary value. Current asset is an asset such as a grant receivable, account receivable, prepaid, or cash that is something you could easily convert to cash. And that's the whole principle of a current asset. How quickly could you turn this into cash if you needed to? Non-current assets are usually property or investments that are expected to be held for longer than a year. You can convert them to cash. It's not easy. I mean, if you want to convert a building into cash, you know it's going to take a while to get to that point. All right. We'll talk about liabilities in a lot more detail, so we're kind of skimming through here. Basically, the same type deal as assets. It's what do you owe, and it's ranked by how quickly do you owe it. If you owe it within the next 60 to 90 days, it should be current liability. If you have a long-term note payable, that's going to be a long-term liability. Okay, expenditures. Payments of cash or cash equivalents for goods or services, or a charge against available funds in settlement of an obligation. Okay, what do you owe? Expenditures are payroll, rent, utilities, and it's in non-technical accounting land, expenditure and expense could be used interchangeably. Because we are being very specific and because we are working with a modified accrual system, and we'll talk about that more too, we're always going to go with an expenditure. Okay? Net position. It's the residual amount left after all other elements are presented in a statement of financial position. Because you're a government, you don't technically have income, but that's basically what net position would be. Think of your own home. When you balance your checkbook, whatever's left, that's your money. So just an easy way to look at it. And that's the main thing I want you all to get today, is that it's not incredibly complicated to follow. Once you kind of have a general idea of this is how it's listed and this is what it's telling me. And hopefully by the time we walk out of here this afternoon, you will have that idea. Okay. Here we go. Long-term liability, loan or any other amount not due within the year. Grant revenue, funds received from federal or state sources. You know what a grant is. You know how to recognize it, but we'll talk more about that in a second. Got a question? Yes, there are copies of the PowerPoint for download. Marie's on it. She'll tell you what to do. Revenue recognition, modified accrual. There are a lot of different methods to do accounting. Cash, full accrual. Governments are required to do a modified accrual, where basically revenues and expenditures are recognized, as in recorded, when all eligibility requirements are met. Okay? So revenue is recognized basically when you know how much it will be and it's available. For transactions in which you're required, that require the recipient to use the resources in or beginning in the following period, resources provided before that should be recognized as advances. Okay, let's make that really simple. If you get to draw your grant down in advance, you will have a deferred revenue, and that is a liability because it's not your money until you spend it the way the grantor has said you have to spend it. Now, the reverse of that is if you don't get your money until you've spent it, then you're going to have a grant receivable because you will spend the money and then you are going to ask for that grant. Okay, does that make sense? That's probably one of the more complicated parts of doing governmental accounting, is working with the revenue recognition and how it flows through on the balance sheet. So don't ever hesitate to ask questions on things like that. All right, do we have questions yet? Okay, statutory and regulatory requirements. NAHASDA says you have to do certain things. If you want to know specifically what certain things they want you to do, 24 CFR 1026, 24 CFR 85, OMB A87, A133, your actual grant award. Those are the places to go to find out your specific detail. Now, one of the things you do need to be aware of, OMB A87 is going away into a super circular, and I believe it starts in December. So you will hear a lot more information. I believe it's 2 CFR 225. Don't hold me to that. but you will have more information about that as we get there, okay? So that's where you need to go to find out what your requirements are. Now, you must provide accurate, current, and complete disclosure of the financial results of financially assisted activities must be made in accordance with financial records. Recipients are required to submit your FFR, your 425 report. And I'm assuming everybody has seen that. If you have, can you just give me a hand raise if you're familiar with that? Okay, so it looks like we're about split. If you are on the Board of Commissioners or you are in a management position in the Housing Authority, you have some oversight, the 425 report is one of the first places you're going to want to look, because it just tells you this is how much money came in, this is how much money was spent, and this is how much money we still have left on our grant. It also tells you how much program income is committed to federal expenditures. Okay? Does that make sense to everyone? If not, ask me a question. But yeah, your 425 and your IHP APR, those are your key reports, plus your audit, obviously. But those are the reports that you can go to really tell you what's going on here. And if you want to know if you're spending your money timely, you can find it out from your 425 and your IHP APR. How much did you spend on federal awards? How much do you have left? How much should you have in the bank for federal awards? All of that information is available. It's a pretty simple form. It's pretty tough to fill out for the accountants here. But once you understand how it works and how it flows, it will give you so much information, and you can compare it to your financial statements and all of that. So it's a good understanding to have. Okay, your 425 is due no later than 30 days following the end of the first 3 quarters, and then the 4th quarter is due 90 days after the end of the quarter. So roughly your final 425 for the year is due the same time your APR. All right, before we start moving into financial reports, anybody have any questions? Okay, financial reports and statements should present a clear picture of the financial results and the condition. Basically, do you have any money? And that's valuable information, obviously. The reports you may want to look at are current month and year-to-date activity, expenditure versus budget, current month versus the same month prior year, current year-to-date versus prior year-to-date, exception reporting of variances, as in if you spent 20% less in payroll for this year than you did last year, you need to look at that and find out what's the problem. Maybe a very good reason. Maybe that you had a lot of people leave and you just don't have that much payroll now. Could also be that everybody's still exact, you still have the same number of people working there and something just got miscoded, okay? So that's where that's helpful. Should also have a report that helps give you progress made on getting monitoring and audit findings closed. So the point that we're looking at here is we want to see what our budget said we were going to do versus what we've actually done. This will only be on your revenues and expenditures, okay? You won't do this on your balance sheet. There's a reason for that. And we're going to think about your bank account again. You do a bank reconciliation every month, okay? And at the end of the year, you still have that balance, and it's going to carry forward into January, right? That's how it works with assets and liabilities. What you have and what you owe do not disappear at year end. With revenue and expenditures, once you've done that for the year and you've got all 12 months in there, then you start over at 0 for the first month, okay? Because now you're just tracking just expenses or just revenues for the year. So comparing it to budget, comparing it to prior year, that does help a lot. But comparing assets and liabilities to prior year, it's not going to tell you much at all. All right, any questions? While I grab a little sip of Diet Coke here. Okay, general ledger. This is pretty much the basic part of your financials. It contains all of your assets, all of your liabilities, all of your revenues, all of your expenditures, all of your equity accounts. Everything that you have, if you have 5 different bank accounts, you're going to have 5 different general ledger line items there, okay? And each bank account will have all of the activity that has gone in, every deposit, every check, and if you have made any adjustments. That's where all of the detail is going to be. List your beginning balance, detail of the changes, and the ending balance in each account. You can look at the general ledger monthly, you can look at it annually, doesn't matter. If you're in accounting, you should be looking at it monthly, and I'm assuming that you are, but I'm also assuming that most people who are accountants may not be in here, because I'm probably not telling you a whole lot you don't already know, but let's see if we can change that. So your general ledger is where you go for the detail of what's on your financial statements. And we're going to get to actually looking at financial statements here in just a second. The accounts are always going to be listed in account number order in the general ledger. All of your assets are usually first, and they'll usually, not always, but usually start with a 1. Your liabilities usually start with a 2. Your equity accounts, net position, profit, what on hand, whatever you want to call it, usually start with a 3. Revenues usually start with 4, and expenditures usually start with 5. Yours may be different. There may be a perfectly good reason for that. I'm just telling you what we usually see, and it's just simply because that's the order. It's not that there's anything fancy, but when you look at financials, assets are first, then liabilities, then equity, then revenues, then expenditures. So, yeah, it's not a real super secret code. It's just seemed fairly logical to the accounting minds. Okay, questions on that? Balance sheet. Marie, is there any way we can pull the balance sheet, or did I just really mess you up and you want to ignore me? Because that's fine. Okay, hopefully we can get it. We'll see. Balance sheet lists all of the assets, which are the things of value, your liabilities, which are payments due elsewhere, and fund balance, fund equity, net position. Okay, balance sheet assets and liabilities are broken down between current and non-current. Again, pretty simple stuff we've already talked about. It's your snapshot of your organization's financial health, okay? Assets, liabilities, equity. The basic accounting equation here is assets equal liabilities plus equity. Now, think about that. Think about your bank account again. Your assets, the total cash that you have available, the total cash is either owed to somebody or it's yours. That's all it is. Assets equal liabilities plus equity. Logical? Okay. We've got a sample balance sheet. There we go. And if we can figure out a way, I can just talk about this. I hope everybody can see this okay. And it's in your notes. Okay, we're calling this the statement of net position. It's also a balance sheet, just depends on various and sundry ways your report is being done, okay? We're not going to focus on that too much today because we're going to focus more on the information in there. Okay, can everybody see this? Can you read this okay? If you cannot, will you raise your hand? Okay, good. All right, current assets. It's just like we said. Cash, cash equivalents. Cash equivalent could be a money market account that's due, within 90 days. Any investments that are short-term, actual cash, petty cash, checking accounts, anything along those lines are going to be cash and cash equivalent. The cash equivalent part means basically you could convert it to cash so quickly that it practically already is cash. All right? Then we've got our receivables, and we're going to list it in order of liquidity, meaning how quickly could it become cash. So we always start with cash itself. We go to receivables. Most housing authorities, you're going to have a grant receivable for the reasons we discussed earlier. If you have to spend your money before you can draw it down, you will have a grant receivable. As a housing authority, you're almost always going to have tenant receivables because that's where you get money. And you'll probably have some prepaid expenses, like insurance. That's one of the more common. You may have utility deposits that you've made. Anything like that would count as a prepaid expense. So there are your total current assets. Does anybody have a question on that? Okay, now we're going to talk about non-current assets. Housing stock. Does everybody have housing stock? Is everybody familiar with the term housing stock? Okay, I'm going to assume the answer is yes. Okay, housing stock is basically an inventory type account because you own that. And it's mutual help, 34 homes, anything like that where they're paying a fixed amount and building up MIPA. The reason this is called, it's housing stock and it's shown at cost is because if that person moves out, it comes back on your financial statement. I mean, you've never transferred that house. It still has the same value it had to start with. If it was a $20,000 house then, it's still a $20,000 house. Okay? Land. Land does not depreciate. It doesn't lose value. It doesn't need to be repaired, replaced, rebuilt. It doesn't come apart. So, again, that stays up, a non-depreciable asset. We always list the rest of our fixed assets at net. It is not a problem if you want to list out buildings, vehicles, equipment, each one have its own separate line item, and then show accumulated depreciation at the bottom. But you cannot show buildings, vehicles, equipment without somehow showing their depreciated amount because that's what they're worth. Does that make sense? Is anybody still awake? Oh, yay, somebody is. Okay. So that gives us our total non-current assets, and then our total assets are total current assets plus our non-current assets. Again, brain surgery here, people. Questions? Okay, let's talk about the liabilities. We've got current liabilities, first of all. Accounts payable. That's always something that's going to be a current because it's your vendor expenses that you've already incurred. You have to pay these bills. You have to pay them most likely within 30 days, probably upon receipt of the statement. Accrued expenses. Those are also expenses, usually payroll tax, all of that has to be paid. You've already incurred the charge for it. So it's going to be high on that list of things that have to be paid. If you have MIPA or any other kind of tenant, I'm putting MIPA in deposits. I have two separate line items here, but we're going to discuss them together. If you are holding money that is not technically yours at this point, it is a liability, and you better have enough cash to cover it. Because, again, it's not your money. Those deposits that people have made do not technically belong to you until if that person moves out and forfeits the deposit, then it's your money. But while they're still living there, that's not yours. MIPA, that is your participants' money. That is not your money until they complete all of the requirements to become a homeowner. When they do, that's when that resolves itself, okay? But until that happens and you have officially sold, transferred title, whatever, you still own the housing stock, You still hold the MEPA for your participant, and you have enough cash that you could pay that to them because it's not yours. Question on that? Deferred revenue, we've already talked about. It's the same type of deal. It's money that you have received from a grantor, but you have not met all of the requirements yet to make it your money. If you get to draw down your funds in advance from HUD, you'll always have deferred revenue. If you do not, again, that's where we're going to go back to the grant receivable. And that's the one thing you really need to notice here. If you are only showing NAHASDA, you will not have both a grant receivable and a deferred revenue, okay? You just can't. And I've seen that happen a lot. So really watch that and make sure you understand, how do we get our money? Because that determines which one is correct. Okay, the other thing we have in current assets is the current portion of our long-term debt. We're going to say that, you know, there's a total debt, and this is a note payable for, let's say, construction or something. I don't know. It can be whatever you want it to be. The total amount is $550,000, but $50,000 of it is due within the next year. So we're going to count that as current portion. The rest of it's still going to be shown down as long-term debt. Okay? Make sense? Does anybody have any questions yet? Because I'm throwing a lot of information at you. Not a one. Okay. Net investment and capital assets. That is basically, for lack of a better word, our land, buildings, vehicles, and equipment, less what we owe on them, which is all of that debt down there. So that's how we get the net investment and capital assets. Pretty simple. Restricted. Restricted can be many, many different things. With a restriction, it's either imposed by the grant, by the tribal governing body, by your board of commissioners, anything that says that this money will be spent only on specific items. Okay? Unrestricted means we can spend it however meets our official rules and regs on how we spend money. Okay? Now, if you look, the total net position is $4,945,000. If you add $4,945,000 to the total liabilities of $1,430,000, you have total assets of $6,375,000. Okay? Does anybody have questions on that? All right, here's just your basic overview. What the organization owns. Your cash, investments, receivables, if you have any inventories. I mean, you may have tool inventories. That's usually the most common. You may be in a situation where you sell excess equipment. That could be an inventory item as well. Prepaid expenses, again, you pay your insurance, what, twice a year, once a year, but it's for an extended period. So that's why it's prepaid. You've already paid for it, you just haven't used it yet. Property and equipment, refundable deposits, always listed in order of liquidity, which is based on your ease of conversion to cash. Liabilities, what the organization owes, listed in order of age. When is it due? Short-term liabilities are less than 1 year. Long-term, generally more than 1 year. Accounts payable, any outstanding invoices you have. Accrued expenses owed but not yet billed, including payroll. You can have sales tax in there, property taxes may be in there, pilot taxes, payment in lieu of taxes, notes, loans payable, deferred revenues, all of that. Changes in net assets, which is also net position, which is also fund equity. All of those words, for your purposes, are interchangeable, okay? If you are a CPA, if you are an auditor, yes, they do each have different meanings. But if you are just trying to understand your financial statement, don't worry about that part. Just go with it. Call it whatever works in your head. Okay, so earnings increase your net assets, obviously, because your net assets are what's left over. Using them decreases it because you're spending it. Revenues greater than expenses will increase your net assets, and expenses greater than your revenues will decrease your net assets. Again, rocket science here. And always just think about your own personal checking account. If you get more money than you spend, you have more money left over, which is your personal net assets. Okay, we're going into statement of activity. Am I ready for another balance sheet? Do we have another balance sheet? We do. Okay. I'm going to spend a brief time on this one because as a general rule, you will look at your financials all together. This is if you have multiple funds, okay? If you've got your NAHASDA, you've got your general fund. This is what it's going to look like. This is most likely in, let me rephrase that. Depending on how your audit is done, you may see a split like this. There are multiple ways that are appropriate to present financial statements for audit. I am not going to get into all of the different ways because that would be an entire class in and of itself, and it would probably make your head explode if this is not something you deal with on a daily basis. If you're looking at your financials, you should be able to see we've got grant here, and we have general fund, tribal fund, whatever. Now, if you also have, let's say you've got USDA rural development money, that would have its own column here. Any additional ICDBG, that could have its own column. Just split out to show in detail, these are all of the funds we have, and this is how it totals out. Okay? The difference between this balance sheet in the statement of net position that we looked at earlier, under modified accrual, which governments operate on, we don't show long-term, we don't show fixed assets, and we don't show long-term liabilities. If your audit is set up this way, to where they do a statement of net position, behind this page, there's a reconciliation as to how it gets to that. I'm just going to tell you now, if you look at this, and you look at the statement of net position, it's pretty much identical except for the long-term stuff left out. All right, questions? Murray, can we get to the statement of activities, please? Thank you. And can we get to the actual form? Is that possible so we can look at that? Give everybody that one. Sorry. Sorry, y'all. I was changing my mind on some stuff right up until the last minute, so Murray's had quite an adventure today. Okay. This is just the basic statement of activities. And if you look at the net position ending, you will note that it ties back to the balance sheet we looked at with the total net position. Okay? We have our expenses. We're saying that we spent, $1,050,000 on operations for 37, $600 on housing services, $595 on rental assistance, $1 million on admin and planning, $700 on modernization, $300,000 again an unallocated depreciation. That's our total depreciation for the year. But like we just showed, we don't show the fixed assets on this one, so we have to account for it. Just go with it. There is a reconciliation in your audit. Try not to think too hard, just take my word for it. Charges for services. That should tie out to what your program income is. Operating grants and contributions. That's your grant section right there. So from looking at this, here's what we know. We know that there was total grant recognized of $3 million. There was $750,000 in program income. If you look down, we can see that there was other income of $30,000 and a transfer from the tribe of $300,000. Okay? We know what our expenditures were with the exception of capital assets. That's how it flows. This is the standard governmental audit. Your audit may very well look different because it's done in an enterprise format, and that's okay. What questions do you have? Because we're going to talk in a lot more detail about this. Can I go back pages on here, Maria? No, I can't because you're in charge. Okay, thank you. Statement of activity, also known as income statement, profit and loss. Summary of your total revenues and total expenditures in a specific period. It's usually reported monthly, can be quarterly, can be yearly. It's going to show your total revenue, and it will give you just the outline of, grants, program payments from tenants, payments on mortgages, any miscellaneous income that may have come up, any interest income you may have earned, any of that. You're going to have all of your expenditures listed out. Payroll, administration costs. On your personal financials for your housing authority, you're going to have a detailed breakout on your expenditures. If you wanted to look at payroll, you could have it broken out by this is the total that we paid in salaries. This is how much we paid in FICA tax. This is how much we paid in federal taxes. How much we paid in state taxes. This is how much we had to match for FICA. This is how much we paid in benefits. All of that can be listed out. Okay? If you have anything that's not, in accounting we call it below the line, and it's something that's not really to do with operations, such as a tribal transfer. That's not really an operation. You got that. You didn't get that from what you do, you just got it. Insurance reimbursement. I'm in Oklahoma. We've had a lot of insurance reimbursements over the last few years. That's not true income because you didn't earn it. It's just you got that money as a replacement. So it goes below the line. Okay? Net income loss for the year flows onto the balance sheet and either increases or decreases the equity on the balance sheet, which we had just talked about. Okay. What's not clear? Because y'all are too quiet and it's making me nervous. So tell me what I need to explain further. Okay. Revenues, earnings, increases, which increase your net assets. Grants and contributions, all kinds including government. Sales of goods, program services. If you all offer conferences, and you charge for that, that's a program. That's a fee you've earned. Sales of publications, unrelated business income. Rents, interest, dividends, capital gains. Questions on that? Those are all top of the page. Okay, statement of activities also. Expenditures, using your resources, which will decrease your net assets. Purchases of goods and services. Anytime you buy anything, it's going to show up on your statement of activity. If you're doing a bunch of rehab work, if you've got a high modernization rehab budget, then all of those supplies that you purchase are going to go through there. Salaries, and if you use contract labor, that'll go through there. Rent, utilities, facility costs, anything that you have to pay to have a building and a functioning office, that'll go on there. Supplies, phones, postage, delivery charges, consultant professional fees, attorney fees will be on there. Other, there's always something random that could go on there. I'm trying to think of a good one. If you all do a meal. If you do a Christmas meal, that'd go in other. If you hand out Christmas turkeys or Christmas hams, that would go in other. Okay, questions? Earned minus used equals your change in net assets. If it's a for-profit, you're going to call it an operating statement or a P&L statement. Net income, bottom line, all of those things. The only difference is in government, your goal is not to earn a profit. That's why we don't use the word profit. The whole point of government is to provide as many services as you can with the funds that you have. Any questions? Okay. Murray, do we have the other income statement available? Do we still have the other one? Again, y'all, sorry. I was changing things around on her. That one. Nope, that's assets. The one that goes with that. All right, let's hold for a second and see if we can get that. In case y'all are wondering, she's wanting to kill me right now. Okay, well, we'll keep going and we can come back to it. Let's talk about receipts. Money received for donations, memberships, admissions, sales of goods, and all other revenue streams of the organization are all counted as receipts. Again, receipts, revenues are very similar. Receipts can be in the form of cash, checks, credit cards, or electronic payments. Usually in housing, we see the locks. It's the cash that comes in. It may be revenue, it may not be revenue. That's the fun of accounting, but it is cash that has come into the organization. When I say it may not be revenue, is everyone clear as to why? You can just give me a yes if you are. Okay, you can have cash come in from your grant that until you spend it, it's not yours. Goes back to that deferred revenue thing. So just because you have receipts, your first thought is to assume it's revenue. Most cases it is. There is a possibility you have to do something else before you can count it as yours. Does that help? All right, well, at least we know Bonnie's been helped. Okay, disbursements. Disbursements, expenditures, pretty much the same thing. Not 100% always, but pretty close. Disbursements are just funds paid out for purchases, maybe indirect costs, maybe refunds, maybe an employee reimbursement, petty cash reimbursements, usually made by checks, electronic transfers, or credit cards. You may have a lot of accounts available to use, but you should have separate accounts for each major cost center. Major cost centers, administration, payroll. If possible, you always want to have a separate payroll account. Wow. Let's wait and see if we can get that other sheet up so we can talk about that. Okay, the main things that I would want you to know, and if you take nothing else out of this class, understand what an asset is, what a liability is, what an expenditure is, what your revenue stream. Ask questions of your organization. Everybody does it a little bit differently, and that's okay, because everybody has a slightly different way of getting information and getting their cash. So make sure you have a good understanding. Ask questions of your finance people. Ask questions of your auditors. Ask questions of anybody who might know. If you are on the Board of Commissioners, I'm going to strongly encourage you to ask a lot of questions on the payments. Don't hesitate to ask questions. Why are we running at a deficit? Why are we approving this check? Is this a reasonable amount? These are the things that you have to ask when you're going to sign off on this. If you are an executive director, make sure you do the same thing. Sit down with your accountants and say, explain to me, how did the information get from the general ledger to here? How did our check that I signed, where is that going to flow through here? And make sure you have a good understanding of the process. If you are an accountant, you already know this stuff. And all you need to do is be ready to sit down. The thing that is most difficult about doing this as a webinar is because I can't hand it to you and walk you through. And I hope that when you go back afterwards and you look at this, you do that for yourself. So you've got a good idea. This is how this number goes together. This is where it came from. If you go look at your financial statements and your general ledger, you will see how all of these pieces come together. Okay? Are there any questions? Because otherwise you're getting out of here super duper early. Can we go to my contact info, please? Thank you, Bonnie. I hope you learned something. I hope everyone got a little something, or at least some kind of understanding that you may not have had before. I'm going to be here to address any questions that you all have. Also, feel free to email me or call me. Let me put my email address on here.
Thank you, Christine. We appreciate you. And it's not so bad having to send out some of these PDFs. So I'm glad that everyone had a chance to see them. And we will put them up on Cathedra Online after today's presentation. So if you want to wait maybe 5 or 10 minutes, we can go ahead and put those up on Cathedra Online as well. Those statement incomes that I'm so familiar with now. Thank you, Christine.
Thank you all.
At this point, I'd like to point out our survey. This helps the Native Learning Center try to improve its services. And so real quick, it's there on your screen, but I'll also send it out to your computers as well. Neat little feature that we've got. And so take a minute to fill out this survey. We appreciate it. One more thing, Christine will be there at our second annual Indian Housing Training Conference. It's in Catoosa, Oklahoma. It's at the Hard Rock Hotel and Casino, and it's August 19th through the 21st. We plan on having just so many different topics. We want you to check out the agenda. It's live on our website. It's going to include economic opportunities, sustainable community infrastructures, information on alternative energy sources, and so much more. So please take a minute to visit thenativelearningcenter.com and check that agenda out. At this time, I just want to thank everyone for attending today's webinar, and we hope to see you on Thursday.